Imagine throwing away every chart, every moving average, every RSI signal, and just reading a balance sheet like it was a love letter from the company. That's exactly what happened. And honestly, the audacity alone deserves its own documentary. We're talking about stripping the cockpit of every instrument and deciding to fly by feel, by fundamentals, by the cold hard numbers buried in quarterly filings that most people scroll past faster than terms and conditions. This wasn't some Zen meditation exercise. This was a real trade, real money, and a genuine philosophical crisis about how we understand markets. See, fundamental analysis is the old school religion of investing the church of price to earnings ratios, debt to equity, free cash flow, and the gospel according to Warren Buffett. But here's the irony. The market in the short term doesn't care about any of that because it's run by humans, and humans are emotional, irrational, and deeply susceptible to whatever CNBC anchor is yelling the loudest that morning. Think of it like knowing a restaurant has the best food in the city, 5-star chef, fresh ingredients, impeccable reviews, but the line outside is empty because someone on social media said the parking lot smells weird. The fundamentals are pristine, the sentiment is catastrophic, and you're standing there holding a reservation, wondering why nobody else showed up. The optimism going in was real. Revenue was growing, margins were expanding. The balance sheet looked like someone actually read a finance textbook. Then the broader market started wobbling. Rates climbed, sentiment cratered, and suddenly, the most fundamentally sound company in your research folder was down 22% for reasons that had nothing to do with the business itself. That psychological whiplash is where most people quit. You did your homework, you were right about the company, and the market still punished you, which feels like studying all night and failing anyway. Howard Marks once said that being too far ahead of your time is indistinguishable from being wrong. And brother, that quote hits different when you're watching unrealized losses grow while the fundamentals stay intact. History is absolutely full of this tension. Think of all the analysts who called Amazon overvalued in 2001, 2008, 2015, and were technically correct about valuation and spectacularly wrong about everything else. The pattern repeats across every cycle. Fundamentals eventually win, but eventually can last a humiliatingly long time, long enough to margin call the most disciplined investor in the room. The lesson cycles love to teach us is that price and value diverge constantly, sometimes for months, sometimes for years, and the market's job is not to reward your research on any particular schedule. Peter Lynch built his entire career on finding companies whose fundamentals the market hadn't caught up to yet, which sounds brilliant until you're 6 months in and questioning your entire methodology at 2 in the morning. Here's the broader truth that fundamentals-only trading reveals. The market is a voting machine short-term and a weighing machine long-term, which means your edge isn't in being right, it's in being right and being able to survive until the market agrees with you. That community of value investors who've held through multiple cycles will tell you position sizing is the only thing standing between a correct thesis and a blown account. A massive misconception worth burning to the ground right now is that technical indicators are somehow cheating or shallow. They're not. They're just measuring different things, specifically crowd psychology and momentum, rather than business quality. Ignoring technicals entirely when entering a position is a bit like knowing the destination is correct, but refusing to check whether there's traffic on the route you'll probably get there, just possibly with far more suffering than necessary. The practical lesson that survives every market cycle is this: use fundamentals to decide what to own, and use price action to decide when and how much. Trading a fundamentally strong company without any price context is like buying a house at full ask in a market that just peaked. The asset is real, the value is real, but the entry created unnecessary pain that a little patience could have avoided. Discipline here means sizing down when conviction is high, but confirmation is low. Paradoxically, the more certain you feel about a fundamental thesis, the more dangerous it is to go large before price agrees. Unemotional strategy isn't about suppressing excitement. It's about building a process that executes the same way whether you're euphoric or terrified, because the account doesn't know the difference between your feelings. Philosophically, Trading without indicators was one of the most clarifying experiences possible. It forced a return to first principles, to asking what a business actually is and what it's actually worth, stripped of all the noise. Discipline, position size, and consistency aren't the glamorous part of the story, but they're the only part that compounds. And here's the beautiful absurdity of it all. The trade worked out, eventually, on the fundamentals, exactly as the thesis predicted, which means the conclusion is simultaneously fundamental only works, and never do this without at least checking the chart first. Markets are humbling, like that they'll let you be right for all. The wrong reasons and wrong for all the right ones, and the best you can do is laugh, learn, and resize accordingly. Whether you're navigating trades like this, building wealth through real estate, or just trying to figure out your next smart financial move, check out our links in the description below, where we can help you get started in real estate investing, connect you with home contracting work, and point you toward the right lenders.